Hello, today is Wednesday, March 24th, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Willms, and I am the President and CEO of the Milwaukee Company. Joining me this morning is Mike Willms. Mike is the Director of Trading and Market Research for the Milwaukee Company, and today, Mike and I will be talking about Special Purpose Acquisition Corporations, or SPACs. And if time permits, Mike, I'd also welcome hearing your thoughts on what's going on with interest rates.
Well, that sounds great. And good morning, Andy, and everybody listening in.
Thank you. And before we get started, I want to remind my viewers that they should keep in mind that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed during this podcast. And that the views expressed in today's podcast are Mike and my personal views, and not necessarily those of the Milwaukee Company. So, Mike, let's start at the very beginning. What is a SPAC?
Well, a Special Purpose Acquisition Corp is a traditional IPO in the sense that investment bankers get together, market the SPAC's common stock, and raise capital. But it's for a shell corporation without any commercial operations, and it is formed for the sole purpose of merging with a privately held operating business.
And is that business disclosed at the time the SPAC is created, or is it open-ended?
Theoretically, there aren't any real limitations at the end of the day, but regulatory requirements are that you should give a general indication of the industry or type of business that might be a merger candidate, but you're not supposed to have a target company in mind at the time that the SPAC's IPO shares are sold.
So I could say I'm interested in acquiring an industrial, a telemarketing, or a retail business, and leave it at that.
And you could say that you're interested in a retail business and then buy an industrial business, but that's kind of one of the idiosyncrasies of the whole process.
So it's basically a company that's formed to raise money to pursue the acquisition of a business that the people who are setting up the SPAC think would be a good investment. That's kind of
exactly. It's a way for the SPAC sponsors to assist the management team of a privately held, non-publicly traded company raise capital and join the public markets.
Okay. So how do they go about raising capital?
The SPAC sponsor would make arrangements with a investment banker and go through a traditional IPO process. And there'd be a road show and a discussion about who the management team would be for the SPAC and officers and directors of the Special Purpose Acquisition Corp. But given the fact that there isn't an operating business, there isn't much else to disclose. The good news from the SPAC sponsor standpoint, you don't have to worry about comparative financial statements, audited financial statements, none of the things that complicate a traditional IPO. And probably the most attractive attribute from a reporting standpoint is that the SPAC sponsor or the management team of the target company actually can talk about future forecasts, which aren't allowed in a traditional IPO process.
Well, I've heard some pretty interesting names associated with SPACs. I mean, it's drawn quite a bit of celebrity attention. I heard,
indeed, it has.
For example, I heard Shaquille O'Neal now has a SPAC that he's the sponsor of. And so when you invest in that, you're investing in Shaquille O'Neal's business acumen.
Well, and there's a number of sports stars. There's a number of hedge fund superstars. And, being a Wisconsin boy here, I'm kind of entertained by the fact that Paul Ryan, our former congressman, is also the sponsor of a SPAC.
Well, I guess having a big name is always helpful when you're trying to raise money. But
absolutely.
So these SPACs, what happens with the once the monies are raised from the IPOs? Where does it go and how is it invested?
Well, that's kind of an interesting process. When the IPO shares are sold, the funds raised go into a trust. And once the IPO is completed, one of two things needs to happen. A merger candidate needs to be identified, and the SPAC merges with the operating company and normally assumes the name of the operating company that was merged into the SPAC. Or in the event that 24 months have passed without a merger candidate being identified, the cash held in the trust needs to be returned to the current shareholders at the IPO price.
Got it. So these SPACs are then they're oftentimes referred to as blank check companies. Do I have that right?
Exactly.
Because they can do whatever they want once they got them. Once they have your money, it's basically like giving them a blank check. Is that where it comes?
Exactly. And the structure was created probably 20 years ago. And there have been a number of articles in the financial media. Barron's periodically will write about the high yield and some of the blank check companies that have focused on actually lending money instead of buying a merger candidate. Verbal definition is blank check. I mean, you're given them the money through the IPO, and it's up to you to determine how to invest.
Okay, great. But what happens if they come up with an investment that the shareholders don't like? I mean, can they go forward regardless of what the investors think about what they propose to do? Let's say Shaq decides in his IPO he's going to invest in something that the shareholders holds no appeal to the shareholders of the SPAC. What happens then?
And that's the interesting part about once the merger candidate is announced, in the event that you as a shareholder don't agree with the transaction, you can vote against it, and it doesn't require a majority vote. Individual shareholders, if they vote against the transaction, receive their money back.
Oh, okay, good. So it's a little bit less. It's not quite as bad as giving someone a blank check because they have to get your approval before they spend the money.
Exactly.
Okay, that makes a little more sense on why people would do this. Now, these things you mentioned, they've gotten much more popular. How big of a player are SPACs in the public markets now?
Right now, I mean, it's really kind of interesting. I feel really sorry for the new hires at Goldman Sachs. They leaked a internal survey, and based on the large number of SPAC deals that Goldman Sachs is working on, some of the new hires are having to work 100-hour weeks. It's really bludgeoned into a huge new segment of the market. There currently are 400 SPACs where they have raised money in either 2020 or 2021 looking for merger candidates. It's really pretty amazing that as of March 11th, 258 global SPAC IPOs had come to market in just the 2.5 months in 2021, which is 2 deals more than the 256 that were done in all of 2020. And amazingly, they've raised $76.7 billion so far in 2021. It's really pretty amazing.
Yeah, it sure is. And, when you talk about these junior bankers working 100-hour weeks, it kind of reminds me of my first year out of law school.
Yeah, no, I mean, everybody's got to put their dues in. So that's why I was kind of, I just not overly sympathetic.
No, I mean,
at my curmudgeonly old age.
No, I understand. It's getting a lot of attention. I saw on Squawk Box this morning that they're talking, that Goldman Sachs is backing off on it and it's going to lighten their load, promises to lighten their load, and so on and so forth. But anyway, so what do you think is driving these SPACs growth? What's the motivation for this incredible growth we've seen?
Well, I think there's a number of advantages for both the SPAC sponsors and the target companies for a potential merger with a SPAC. But first and foremost, it's a very profitable transaction for the sponsors. Normally, for a very nominal dollar amount, like $25,000, they end up with what are called founder shares that allow them to purchase a 25% interest in the SPAC itself. So if they buy 25% of 100%, in essence, the sponsors end up with a 20% ownership stake in the SPAC upon creating the merger transaction. And it's very similar to the hedge fund industry, where the 25% founder shares are considered the quote unquote promote, just like the management fees of a hedge fund.
And I think you mentioned earlier, since there's no ongoing business, then you don't have to worry about business risk factors while you're in the process of raining money. And these SPACs are kind of boilerplate, aren't they? So you can get them done pretty quickly.
Exactly. Regulatory filings don't require the detailed business descriptions and risk factors that you'd see with a traditional IPO. And, that allows a SPAC IPO to basically go through the registration process in as little as 8 weeks. It's really pretty amazing.
Yeah, it sure is. Well, okay, so now that we know what these kinds of things are, in terms of, our listeners, their investments, do you think this is something appropriate for the typical individual investor to consider?
There are places for these type of investments. I mean, if somebody comes out, and the most recent SPAC stories have been around a couple of new SPACs that have been sold that are going to focus on the space industry and launching satellites and so on and so forth. I mean, it gives you a chance as an individual investor to get in at the IPO level that you normally wouldn't if you're not a large institutional buyer. But by the same token, if you buy into a SPAC, you never really know what the target company is ultimately going to be. So that creates a very high risk, high return kind of environment.
Yeah, I think one of the greatest evidences of how risky this is and how much opportunity is there to lose money is that, the short sellers, who tend to be pretty smart, right? They have been shorting a lot of these SPACs. Once they've identified the company and completed their merger, they're actually shorting the stock because they think these SPACs, are destined to go lower after the bloom is off the rose, so to speak. Yep. So, if it's a SPAC that you have a lot of personal firsthand knowledge of, that's one thing. But if it's something that you've heard about at a cocktail party or something like that, my advice is for individual investors to stay away from that. It's just, there's too many moving parts behind the scenes and too much leeway for me to personally get comfortable with the SPAC as an investment. So,
and I think the bloom off the rose comment is very appropriate. Some of the sponsors that had successful SPACs back in 2019 and 2020, when this was first starting to gain momentum, have now got 4, 5, 6 additional SPACs that they've come to market and raised money. And the majority of the stocks are sold at $10. Some of them have traded up to $50, $60 a share without having identified a merger candidate. And those are the kind of issues that I think the short sellers are targeting. There still isn't a value creation transaction that's occurred that would allow for that kind of evaluation.
Yeah, it clearly is a speculative investment. And I don't have, any opposition. I don't think there's anything wrong with speculating as long as you fully understand the risk you are taking.
Exactly.
Then you make that speculative investment. All right. Well, Mike, we do have a couple of moments left here. I'd like to change gears a bit, if you don't mind, and ask you for your thoughts about interest rates, which, as we all know, have risen substantially from the beginning of the year. Do you have any thoughts about what the cause might be, and do you think this upward trend will continue?
Well, I guess I'd make a couple of quick comments there. I mean, this was something, even based on our internal conversations, we could ramble on about interest rates for hours. But, I think that what you're seeing is a concern about inflation. And I believe that that's a very appropriate area to be focused on. You had a drop in inflation with the start of the pandemic 12 months ago. And, a lot of the rhetoric is about a short-term increase in inflation. But with the Fed changing the way that they target inflation to an average versus a set 2%, and a willingness to allow inflation to trend over the long-term target of 2%. If you're in a fixed income investment and the inflation rate exceeds the return on your fixed income investment, you've got a negative real return. So right. Even at 160 or 170 basis points with inflation targeted at something over 2%, your purchasing power is deteriorating over time with a negative real interest rate. With that said, I mean, I think the longer end of the interest rate curve is increasing simply to get a normal slope to the yield curve, where short rates are still held at 0 to 25 basis points by the Federal Reserve. The 10-year at something north of 150 basis points, you're starting to get a normal long-term risk premium or term premium built into the yield curve. So things are starting to look a little bit normal, and I think the fixed income markets will stabilize once we get back to having a positive real return, looking at where inflation is relative to yields in the Treasury market.
So in some, it's the investors are expecting a higher rate of return because on their investment in bonds, because they think that inflation is going to go up, and so they want the purchasing power of the return of the bonds to reflect that inflation risk.
Exactly.
Yeah. Okay. Well,
it's kind of this goes back to my days on a fixed income desk where I lived through the quote unquote bond vigilante days, and the bond vigilantes are threatening to come back here, and it's not a matter of looking for a real return, but demanding a real return before they're willing to own treasuries. So be interesting to see how that plays out.
It will be indeed. And, there's plenty of difference of opinion on this. You and I tend to have a similar view about the risks associated with rising interest rates and rising rates of inflation. But those risks have been present for a long time, although I don't think they've ever been quite at this level. When you have the government injecting trillions of dollars of money into the economy, that creates the potential for inflation. Now, but in my mind, but you and I kind of grew up under a more traditional economic viewpoint, classical economics, and there's a whole nother school of thought that inflation won't be driven by deficit spending, and so interest rates don't have to go up because of deficit spending. And some very smart people believe that. So there's no absolute certain outcome here. And that's usually the way it is with investing, right? So, in fact, next week I will be talking with Jim Picerno, who is the Milwaukee Company's Director of Analytics, and you're and my colleague, and he has a little bit different perspective than you and I do. He's a little less concerned about the interest rates going up dramatically or inflation shooting up dramatically at this point. And when I say dramatically, by the way, I'm not predicting a return to the old 10% inflation rates.
Double-digit inflation isn't on the horizon.
Well, I guess the point being that there are arguments both pro and for and against rising interest rates, and what's going to happen with interest rates and what's going to happen with inflation. And so I wouldn't be recommending that anybody make a big bet that one or the other is going to occur. But I do think it makes sense to probably I've said this several times in the past, look at taking some risk off the table. We did that for our client accounts at the very outset of the year, and even back in 2020, we reduced some interest rate risk, and that has actually proven to be was a good move so far. And maybe that's something our listeners want to consider. Another thing they might want to look at is some alternative investments that tend to do well in a rising rate or rising inflation rate environment.
Exactly.
And we're looking at doing that, of course, in our client accounts right now, too. So if anybody's interested in learning about what we're trying to do there, what we're thinking about there, they should feel free to give us a call or shoot us an email, and we're happy to talk to them. All right, Mike. Well, the time is flown, and we are now time to wrap up here. So I will just say thank you very much for joining us this morning. I appreciate it. And to our listeners, I will say please keep in mind that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial investor or a professional, who is familiar with your personal situation and your investment objectives. And with that, I wish you all a good day.
Thanks, Andy. Have a good day, everyone.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.